major property developer. And let's say the total syndicate exposure is $1 billion and that bank has a $200 million exposure. If the syndicate says they're going to halve the amount of loan they're prepared to provide to that commercial property developer to $500 million, the bank's proportional exposure is halved, with Rudd Bank stepping in with the remaining $500 million. Well, their exposure isn't that great if it's out of a total pool of $30 billion. So proportionally, they have maintained an exposure, but on the other hand, their total exposure to that institution is much smaller. Let's go to what was one of the main reasons for the establishment of Rudd Bank. The Prime Minister said that they were concerned about foreign banks leaving Australia. There's no foreign bank restriction in this legislation. It doesn't say that Rudd Bank will only step in where a foreign bank withdraws from a syndicate. It says any bank. In fact, it goes beyond any bank. The legislation actually states that the entity can step in relating to commercial property assets in situations where finance relating to the assets is not available from commercial providers other than Rudd Bank. So a commercial provider could be any number of different entities, and they go on to say the assets would be otherwise financially viable. But that's only in relation to property, mind you. There's no such restrictions in relation to what could be a pool of money for a whole range of different initiatives. Initiatives similar to those that were undertaken by the State Bank of Victoria, the State Bank of South Australia and Western Australia Inc. And Lord knows, Mr Deputy Speaker, as you will recall, as the member for Hume, I was involved in the privatisation of the State Bank of New South Wales. And at that time, even though we had the financial collapses in South Australia and in Victoria, when I was engaged as one of the project managers on the privatisation of the State Bank, we as a shareholder, the New South Wales Treasury, had to do a due diligence on the State Bank of New South Wales, even though as a shareholder we were meant to be fully informed of what they were up to, but because we weren't fully informed, we had to do our own due diligence before we let anyone else have a look. And what did we discover? That Nick Whitlam, as the former Chief Executive of the State Bank of New South Wales, had taken them on balance sheet risk that never would be undertaken by a private sector bank. Never undertaken. And why he was able to do that? Because it was a government-guaranteed entity. It was a government-funded, government-guaranteed entity. And let's be very clear about it, because again, I come back to my own personal experience in the privatisation of the GIO, when they had a minority interest in a state insurance office. It was deemed to be a Crown entity because of that minority interest. So don't be under any illusion about this. This will be a Crown entity. It is a part of the Crown. It is borrowing money on the Crown against the Crown guarantee. It will be treated by the markets as a Crown entity in the very same way that Fannie Mae and Freddie Mac, even though, quote, privately owned, were treated by the markets as part of the US government. And that's where much of the subprime crisis actually started. Let's be very clear about that. This is a Crown entity. A Crown entity without the normal corporate governance provisions. It is a Crown entity without the normal prudential supervision. It is a Crown entity that is entering into an area where governments have feared to tread since the spectacular failure of Labor state government banks, and now Labor, true to its nature, true to its tune, is coming back to the pit, going to taxpayers, and on this occasion raising up to $28 billion to go into the commercial property sector. Lord help us. Lord help us. As if one lesson wasn't learnt, as if two lessons weren't learnt, as if three lessons weren't learnt. And now it's all happening again. It's like Groundhog Day. You let Labor go at the Treasury, they have to be involved in banking and commercial property. Commercial property to boot. The justification for this initial, for the bill, is foreign banks pulling out. And as the Leader of the Opposition said, the very best advice, and look, let's be fair dinkum about it, Treasury couldn't even state the name of the bank that had pulled out of Australia. That's very important. We asked them, straight to their faces, which foreign bank has pulled out of Australia? They didn't want to state it. Well, in the Australian today, there's referral to RBS, Royal Bank of Scotland, now owned by the British taxpayers. And they said they've reduced their exposure in Australia. Well, OK, that will happen from time to time. Of course it will happen from time to time. But the latest lending figures clearly indicate that the Australian banks are expanding their lending operations in Australia at this point of time. Secondly, the latest information clearly states that the Australian financial institutions are financially viable. In fact, the four major banks who are tipping in $500 million each to this initiative are amongst the 12 best capitalised and largest banks in the world today. And I would like to think that whilst that may have something to do with their good management over time, there hasn't always been good management in those banks, but it also directly relates to the fact that the Australian banks have the very best prudential supervision in the world, have the very best regulation in the world. And that came about overwhelmingly as a result of the reforms of the Wallace Inquiry under the previous coalition government, initiated by the then Treasurer Peter Costello, the member for Higgins,
good member,
and followed up with the Financial Services Reform Act, which significantly changed the way that financial products can be sold to the retail sector. And that was a bill that I introduced as Minister for Financial Services. And they were hard bills. I mean, Labor was amending those bills extravagantly, one would say, in the Senate, as it was. They were simply moving ridiculous, spurious even amendments, because they felt the need to be relevant at that time, rather than moving amendments that would improve the bills. So let's be very clear. The government said that it would be entering into this so-called partnership, seems like a very skewed partnership, going into this partnership so that they could fill the vacuum when foreign banks pulled out of Australia. Well, can I just say this? Far from filling the vacuum when foreign banks pull out of Australia, this bill is going to encourage them to pull out of Australia. It's going to encourage them to pull out of syndicates at the first available opportunity so that they know that they can look for better assets to invest in Australia than commercial property, at the same time that the government is standing behind them with Rudd Bank ready at the taxpayers' expense to fill the vacuum. Mr Deputy Speaker, this is bad legislation. It's backing bad policy. It's backing bad policy because this is what the Labor Party does. The Labor Party goes into this deep, dark abyss of debt and deficit in a search to be all things to all people. Sometimes you have to take a stand. You have to take a stand against those people that want free money. You have to take a stand against those people who are seeking to gain commercial advantage out of taxpayers. But most significantly, you have to take a stand for the taxpayers who are going to be burdened by this very significant exposure to the Australian commercial property market at a time when there are a large range of areas of the Australian economy that could do